Hello and welcome to our podcast, looking at the industry outlook and key themes for the year ahead. Let's talk about the impact of the 2025 Data Act and how that might shape advisor technology in the year ahead. Your thoughts on that?
Well, I mean, this is all about I was at the TISA event yesterday in London, which is their annual conference, and talking to Mark Garnier, who is the opposition chief secretary to the Treasury, but at the time was chair of the Treasury Select Committee. 2016, I think, open banking, which was a big focus for the then government and has been transformational for the industry as financial services as we know. And this is really following on from that and the recognition that in opening up data, it provides choice, it provides greater competition, and greater competition breeds choice for consumers, which regulators, government, and I think we all see as a good thing. And I think, that goes the way of the world, right? The ability to plug and play into your Apple ecosystem, your Android ecosystem, your Microsoft ecosystem as consumers. That is the way of the world for technology. And in our industry, it is no different and should be no different. So, yeah, more integration, less rekeying, the ability to get client data in and out of systems, including Dynamic Planner. We are focusing very, very hard on that. We've got a big open API program. We've had an open API for a number of years. We're focusing on expanding it, deepening it, adding this modern model context protocol layer, which is the layer that will ultimately enable agents, agentic AI, to talk to Dynamic Planner. So we see that as a really important part of our technology architecture and strategy to be able to make it easier to integrate with Dynamic Planner as a digital advice platform, get data in and get data out. Yeah, very, very key.
It feels like there's been enormous progress made in helping advisors with their administrative burden in recent years, largely through technology. I mean, are you seeing that? Are advisors feeling better about their administrative burden? Does it feel like less of a weight, or are they still, is there still a way to go on that?
Still a way to go, because we've spoken about AI and how that has eased some of the burden and taking hours down to minutes. But the problem is, obviously over the last 10 years, AI is advanced, but over the last 10 years, we've had a huge wave of regulation coming into the industry. So it's a kind of a balancing act, really, because, the time saved potentially on AI may now be taken up with increased regulatory burden. So a report came out last week, which said the average advice firm now spends 13 hours a week on compliance. And is a huge part of their time. So yes, I guess there's been some improvements. AI may help, but it's the regulation is I think almost taking away some of the benefit of AI in that sense.
Yeah, I mean, we see that too. If I can proffer a view of the future, Dan, I think we'll find this is an area where AI can help hugely. I think, as I started by saying, the ideal has to be to get advice right first time, every time. And the deterministic models are key to doing that. One can't rely on technology that is essentially guessing. I mean, it's very smart guessing, but it is still guessing as to what the answers are. We know how to build probabilistic models. They're quicker, they're cheaper. So that as the backbone is key to ensuring compliant result every single time. The piece that we've been working on really for the last 2 or 3 years is the data that stems from that advice process. So we've got over 1 billion data items in our data lake. I'm incredibly proud that this month we're not only ISO 27001, but we have been the first fintech to be awarded the ISO for AI development and AI management, which we're really, really, really pleased about, which goes to our processes. But we've gone through that because now we've got we're capturing so much data, and we're beginning to play that data back to firms in a format where they can use it to ensure compliance. So compliance, for example, with annual review reporting. We launched that 6 months ago or so, reporting around at retirement and in retirement advice. So actually automation, one of the great things about automation is it does generate huge amounts of data, which you can use for a more data-driven regulator. We're not there yet. I completely agree, Dan. The regulatory burden is there, but it's not going away. So, here we think technology has a bigger role to play, both in enhancing reporting, providing real-time guidance, in the generation of advice as well. We're excited about the potential there, but mostly around the ability to automate reporting and make sure that things are right first time. We think can really cut into that compliance
just to loop
overhead.
back, I was just going to ask with the data use and access bill, which obviously went through earlier this year. Do you think that's going to help? I mean, it does give the consumers kind of far more control over their personal data, and for the first time, kind of allows them to direct organisations to share it with with third parties of their choice. So I know historically advisors have found it difficult at times to get data from, for example, pension providers. But with this act, it will be easier for the consumer to say, actually, we want you to share that information with my advisor, and they've just got that a bit more control over that process.
Yeah, I mean, I think it will drive the right behaviour. This industry is wired backwards, Dan. I've said this for a long time. It's wired from product providers to customers, not from customers to product providers. And that is because it is an industry, technically, which was born out of selling insurance, fundamentally. And that a lot of that data sits in pretty archaic platforms, with some archaic practices that go around it. But that is changing without doubt, and certainly from our end, we've built now Dynamic Planner so that you can get all of your data out of Dynamic Planner every night if that's what you want to do. So the ability to move data around is key to a modern technology strategy. It's key to good consumer outcomes, and it's actually key to a good modern digital economy. And it's something that we've certainly focused a lot on, the ability to make it easy to get data into Dynamic Planner and out.
Ben, 2025 has been a very noisy year in lots of ways. I wonder if you could talk a little bit about the other things that advisors are doing to kind of focus on what they can control, whether it's kind of vertical integration, risk-based benchmarks, that sort of thing.
Yeah, I mean, again, uncertainty does drive demand for advice. And so throughout all of the uncertainty, we live in a very uncertain world. I think we've been saying that certainly for as long as I can remember, but at the moment it feels, politically, internationally, even markets over the last week or so have felt particularly uncertain. So, what are firms doing about it? Well, we talk about vertical integration. I think I come back to this core principle that people don't make financial decisions unless there is trust involved. And what are the best ways of delivering trusted advice to clients? Well, one is absolutely to be able to control the controllables. And we are seeing the growth of vertically integrated firms. I would argue that many firms are virtually vertically integrated anyway. They've got very strong centralized investment propositions, but there are something like 40-odd private equity-backed consolidators now in the market. And, they are consolidating principally with a view to being able to control more of the kind of end-to-end process, which, so long as the customer is first and the end client is first and foremost in their minds, as I know in many cases they are, what they're trying to do is to deliver the benefits of scale to the end client, whether that is through pricing, whether that is through a more a clearer, more consistent proposition, whether that's through the deployment of technology to augment that proposition. We're definitely seeing the rise of that form of consolidation, and that is only likely to accelerate in 2026. There's talk of the consolidation of the consolidators, of course, and I think that's a reasonable view to take, so long as firms are able to take that scale and deliver benefits to the end client. They should also be able to see greater benefits to themselves and their shareholders as well, for sure.
Yeah, I think I agree with Ben. I think when 5 or 6 years ago, when the consolidation seemed rife, it felt, perhaps it's an unfair statement, like it was more of an asset grabbing mentality. So these PE-backed firms who probably wanted to grow quite quickly and at scale, it felt as though they were kind of almost snapping up any firm that they could lay their eyes on. Perhaps that's what prompted the FCA's consolidation review, which is underway at the moment, and I think is due to report back soon. It seems to have shifted away from that now. The pace of consolidation seems to have been slowing a bit, and as Ben says, I think these firms now are focusing more on, we've got these firms. How do we properly vertically integrate them into our network? And yeah, it seems like it's more about integration now and less about asset grabbing. And I don't know how much of that has been stemmed from the FCA review and how much has just been, focusing more on due diligence. But there does seem to be a shift. I've noticed that over the last 6 months to a year, definitely.
Yeah, absolutely. Now, just finally, I wonder if we can wrap up by talking a little bit about targeted support, what we know about what it's going to look like and how close advisors are to being able to deliver that. Ben, that question to you.
Yeah, I mean, look, without trust, there will be no action. So we've just about to publish some research that we completed. We have shared it with the FCA. We researched 1,000 end consumers. About half were advised, half non-advised, 50-50 male, female, spread of demographics. So broadly the UK population. And the good news for targeted support is that when posed with a question along the lines of, you get an email or you get a communication in your phone saying something along the lines of, we think you may have too much money in cash and you might be better off investing it because inflation could erode the value of your cash. Are you interested? Almost 2/3 of people say, yes, I'm interested. And so, there is a real opportunity for engagement. And again, we believe engaging through tram or smartphone apps, a fantastic way of doing that. The challenge comes when you then go a step further and say, okay, well, assuming these things are true, so things like you've got your debt under control, you're willing to take some risk, you don't need this money for 3 to 5 years and so on, i.e. sort of prefacing the targeted support targeting, we could find no evidence that targeted support would lead to action. We could not see that targeted messaging in our research was likely to generate people actually taking action on the suggestion, with one exception, and that was where the consumer was in an advised relationship or had been in an advised relationship in the previous 12 months. And that we firmly believe is because they have a trusted relationship. They understand, they've been sort of taught, if you like, well, to understand this kind of risk return trade-off, and they were more confident. And so what this research leads us to, so that we then looked at that cohort who were expressed some greater likelihood that they might take action. And interestingly, they were younger, they were sort of mass market or mass affluent, so it was sort of 10k to 300k net wealth or investable wealth rather. They were slightly younger and they were willing to take risk. So that's good news. But I think what we'll find is that the really important thing from this AGBR, Advice Guidance Boundary Review, is the arrival of a continuum. Because today, consumers are faced with a false choice, right? I either don't get any advice or I have to go for the gold-plated option, which takes hours and costs relatively a lot of money unless I've got quite a lot of money. That's a false choice. That gap was created post-RDR. We all understand why. I think targeted support is the first step in the right direction to open up an engagement and an engagement with the consumer. Some people may well go ahead and act as a result of it, but I think what it will do is act as a really powerful on-ramp for advice, simplified advice, if that then comes out, and then investment advice and perhaps holistic planning as well. So huge, big step towards in the right direction from us. We're gearing up to support it for those customers of ours that want to support it. Again, Tram, fantastic delivery mechanism for delivering targeted support to segments digitally and automatically. Great for setting up calls with advisors and so on to make the handoff to advice, if that's what happens, as seamless and frictionless as possible. So we can see real possibilities. We're really excited about the continuum. And, we've set out our vision, Cherry, that by 2028, we have worked with our customers to close the advice gap. We believe that is now possible with this regulation. Trust breeds action. Let's not forget that. But the regulation is now likely. The technology is here. We have the technology platform to do this. And we believe with that advice continuum in place, over the next 3 years, it should be possible for anybody who wants to get advice with a small a, whether that is, guidance, support, simplified advice, full advice, to be able to access it at a price point that is right for them. So we're very excited about this.
Okay, great. I mean, Dan, what's your view on advisors' relationship with targeted support?
I think the initial worry was that they would lose clients. Would targeted support take away some of advised clients? I don't think that will be the case. As Ben said before, clients who have received advice are very, very unlikely, I would say, to then go for a watered down version of it. They're not going to receive this whole holistic financial plan with an advisor and say, actually, you know what, I want to be lumped in with, a group characteristic type scenario where people like you might benefit from this. I don't think that's, an issue, and I don't think advisors are particularly worried about that anymore. It's a great targeted support is a great thing, as Ben said. For the consumer. There are 15 million people out there who need help with their money, with their retirement planning, people who have money in cash that need to have it in investments. There's so many people out there who aren't going to get the best outcomes without it. So I think from a consumer point of view, yeah, absolutely great. From an advisor's point of view, I think it all comes back to the data. Ben, we've mentioned data a few times on this podcast, and that just shows the importance of it, because I think for your small to medium-sized advice firm who perhaps don't have the same data sets as the larger advice firms and the insurers and the banks and the pension providers, I think for the large advice firms and the ones I've just mentioned who do have access to this huge amount of data, it will be brilliant for them, because I think they can offer that service, at scale. They can reach the right people in the right kind of demographic. But I think for the smaller to mid-sized advice firms, I'm not sure there'll be a huge amount of take-up. I don't get the impression that, they're already drowning in regulation. It's a service that, the FCA have indicated that they'll probably have to provide free of charge or certainly at low cost. I think for those smaller firms, that's going to be probably one step too far, and they may not see the benefit from doing that. But certainly the bigger firms will take up, I think.
Great. Okay, well, we'll wrap up there. It sounds like 2026 will be another busy year. So thank you both. Thank you, Ben. Thank you, Dan, for all those insights today.